All right, let's see what's on the radar for Rebecca Teltscher, portfolio manager at Newhaven Asset Management. There are two energy companies you want to talk about. First up, we'll start with Enbridge. Perfect week to be talking about energy companies.
Yeah, again, I mean, this all goes to what's been happening in the markets. The markets continue, we keep seeing all-time highs, record highs, and the only sectors to be really hit are Canadian oil and oil transportation companies. The funny thing is, like we said in the last segment, if there is a displacement to Canadian oil, this is a medium to long-term trend. The funny thing is if I think there's tons more risks that are near term that are being completely discounted by the market right now. So, the way I look at it is like we need to be positioned defensively, like geopolitical risks are at all-time high. The economy is weakening. Now is a good time to be defensive. And okay, if you want to like bring all of these energy companies down, I'll just buy some more because the yields are sustainable. So, Enbridge is down 5 to 6% in the past week alone. The dividend yield is 6.2%, and it's continuing to go up because that yield is backed by long-term contracts, take-or-pay contracts, whether that oil is is on the pipes or not. But they are, because those pipes are full.
Yeah.
They have $37 billion of CapEx and growth projects. So, the one project I would say that's at risk is, they made an announcement, in Q4 of last year that they're going to expand the main line. And so, okay, in 5 to 10 years, if Venezuelan oil depletes, maybe they're not going to do that expansion. But that was a $1.4 billion project out of $37 billion. Yeah. It's really minimal for them. Most of their growth projects are actually on the gas distribution side, which is very utility-like. Most of their growth and their acquisitions in the past few years have been on the gas side and on the utility side. So, they, on a relative basis, yes, they still have those oil pipelines, but relative to their overall, it's getting less and less as they invest in gas.
And I think we forget the demand is still growing for oil, right? It's not going away. I think they're talking about the next half of the second half of the century being one of the most critical. It'll be one of the largest consumption half century ever.
Absolutely.
Because we still need populations are growing.
I really think it's the fundamentals are not like the people who are selling Enbridge and CNQ right now are not the fundamental investors. It's that quick money. It's the hedge funds. It's the quants that are looking for a trade because the fundamentals are still actually very strong. Like the other stock I wanted to talk about was CNQ. I mean, that's down 9% in the past 5 days alone. Dividend yield 5.6%, so really high and still growing. And then again, let's look under the hood for how CNQ produces their oil. Only 15% of their oil is conventional heavy, and that's the oil that would compete with Venezuelan. 40% of their production is actually natural gas, which is underappreciated right now as natural gas prices are really low.
I was looking, gas prices there was a prediction that it could go up about 80%, did I see, for the year?
Yeah, I mean, like we've had a really
for natural gas.
We've had an abnormally warm winter as well, so natural gas prices are off. But the rest of Canadian natural resources oil production, it's oil sands, but it's actually upgraded. So it's called synthetic crude. So they do additives to the oil that comes out, and then it actually turns out to be light oil that competes, with WTI, or actually it's a better grade than WTI. It's a light oil, so it doesn't compete at all with what would be, Venezuelan production coming on in the next 5 to 10 years. So my opinion, both of these stocks are off. Can we see lower oil prices in the short term? I do think so. We saw that yesterday because Trump is announcing that they are buying Venezuelan oil, but they're not buying new production. They're buying existing stockpiles. So I think as we see those stockpiles or the reserves come down, we could see oil prices be hit on a short-term basis. I think on a long-term basis, these are really good long-term opportunities.
Well, and aren't we running overproduction at about 900,000 barrels a day right now?
Sorry, for
overproduction, there's excess they have right now, isn't it? Like almost 900?
For oil?
Just in general.
Yeah. So, I mean, again, that goes to like OPEC Plus that are, that they are overproducing right now. And then again, we are going into a weaker economy. As we go into a weaker economy, the demand for oil, which actually has been pretty strong as of late, but the expectations for oil demand are coming down if we do go into a weaker economic environment. But again, those are normal ebbs and flows of an economic cycle. I do think, over the longer term, these companies will do fine. But companies like CNQ, whether oil, we've gone through this before. Mm-hmm. We've gone through prolonged weakening prices in 2015 for many years. We went through negative oil prices in 2020. CNQ continued to operate.
They know how to weather these things.
They didn't lay off one employee. They continued to raise their dividend. They didn't speculate. They're in it for the long term. Again, when it comes to oil sands, all that CapEx has already been spent, so the maintenance CapEx is actually very low. Mm-hmm. So they're going to continue to produce in any kind of environment. I think even if we see prolonged oil price weakness as it relates to, Venezuela's reserves coming down and stockpiles coming down, and weakness from lower demand, I think they'll still continue to thrive as we come out of it.